Yeah, so we're in a very low volatility environment right now, and many people have see that low volatility as a sign of complacency or a sign that you should sell equities and take profits. And purely statistically, that's just not the case. If you sold every time you're in a low volatility environment, you miss a huge amount of upside. The low volatility environment we're in today reflects the very stable economic environment we're in. So the economic data is incredibly stable. It's low volatility economic data. We're somewhere in the middle of a very long expansion. So while that continues, we think the low volatility regime will continue. That's an environment where you're generally being paid to take risk. Look at, there are areas of the market you're being paid more than others to take risk. And it's an area where you effectively buy the dips. It's not that you won't get dips. Of course there will be. There'll inherently be turmoil in the market. There'll be drawdowns. But in these low volatility regimes, you should be buying those dips rather than panicking and selling out.
You think we're somewhere in the middle of this economic expansion and not towards the peak of it?
Yeah, so I think one of the notable features of the cycle is it's been extremely long. So we're now in the 8th year of the expansion. And for my entire career, the average length of an economic expansion has been around 8 years. So many people...
So why do you think it's not about 10?
Because recessions don't start on a clock. You shouldn't measure the length of a cycle in years. You measure it in terms of the excesses that are building up in the economy, to what extent is excess capacity being consumed. So when you adjust this cycle for the fact that it's been one of the slowest cycles we've seen in economic history, actually, you come to the conclusion that rather than being at the end of the cycle, we're somewhere in the middle. And actually, the time to the next recession could be measured potentially in years. So we feel that we've got some way to run.
And why do you feel like we're somewhere in the middle? Is it because of wage inflation?
What you're not seeing is any of the signs of excess in the economy that would typically build up if we're towards the end of the cycle. So we don't see that in the labor market today. So you're right, wage inflation is low. We don't see that in broader consumer prices. So we think there's some upside potentially to inflation going forward, but we're still in a very benign price environment. And we don't see it in terms of leverage. We think about the signs of excess leverage that built up towards the end of the last cycle. We see very few signs. See some pockets of that, areas like auto loans, but you don't see that broad increase in leverage, which would flash a red warning sign that perhaps we're close to the end of the cycle.